Completing the accounting cycle and classifying accounts, Chapter 4. Learning objectives. 1. Describe and prepare a worksheet and explain its usefulness. 2. Describe the closing process and explain why temporary accounts are closed each period. 3. Prepare closing entries. 4. Explain and prepare a post-closing trial balance. 5. Complete the steps in the accounting cycle. 6. Explain and prepare a classified balance sheet. 7. Calculate the current ratio and debt-to-equity ratios, and describe what it reveals about a company's financial condition. We won't be doing Learning Objective 8, which is reversing entries. Vignette video. The Cupcake Girls is a 13-part duo soap that follows entrepreneurs and best friends Heather White and Lori Joyce in their hectic and often hilarious journey to build a cupcake empire. While working to expand on the sweet success of their business, you can actually watch the video if you're interested. The accounting cycle. 1. Analyze transactions. 2. Journalize. 3. Post. 4. Prepare unadjusted trial balances. So we did those in chapters 1 and 2. 5 adjust, and 6 prepare an adjusted trial balance. So we did that in chapter 3. Number 7, prepare statements. Number 8, close. And number 9, prepare post-closing trial balance. So that's what we're going to be doing in chapter 4. The worksheet. An optional working paper that can be used to simplify the preparation of financial statements. It is prepared before adjusting entries are made, captures the entire accounting process, often used by auditors, and it's helpful in preventing errors. A blank worksheet. So we have a blank worksheet for Organico for the month ended March 31st, 2020. Steps. 1. Enter unadjusted trial balance. 2. Enter adjustments. 3. Prepare adjusted trial balance. 4. Extend adjusted trial balance to financial statement columns. 5. Enter profit or loss and balance financial statement columns. 6. Prepare financial statements. Step 1. Prepare the unadjusted trial balance. Step 2. Enter your adjustments from your adjusting journal entries. Step 3. Prepare your adjusted trial balance, which is your trial balance plus or minus the adjustments. Step 4. Extend the adjusted amounts to the statement columns. So we're going to take everything from the chart of accounts or from the trial balance and either classify it as an income statement item or a balance sheet item. Step 5. Enter the profit and loss and the balance financial statement columns. Step 6. Prepare financial statements from worksheet information. The closing process. The closing process occurs at the end of an accounting period after financial statements are prepared. Closing entries. 1. Reset revenue, expenses, and withdrawal account balances to 0 at the end of the period. 2. Update the capital account to reflect profit or loss and drawings from the period just ended. 4-step closing process. REID. Close revenue accounts to income summary account. 2. Close expense accounts to income summary account. 3. Close income summary account to owner's capital account. 4. Close drawings or withdrawals account to the capital account. Only temporary accounts are closed, resulting in a reset to 0 for the next accounting period. Permanent account balances carry into the next accounting period. So temporary accounts are your revenues, expenses, withdrawals, and income summary. Your permanent accounts are your assets and your liabilities and your owner's capital. Step 1. Close revenue accounts to income summary. So we're taking our food service revenue balance and subtracting it out, so you debit that in order to bring this account to zero. Then you do the same thing with your teaching revenue. So it's in there as a credit of $300. If we debit that amount, it brings it to zero. And then add those two together and move them into the income summary account. So this is just a holding account. Step 2, close expense accounts to income summary. So the same thing goes here. So if I have depreciation expense of $200, if I credit my expense account, it will bring my account down to zero. So we clear out all of these accounts: depreciation, salaries, interest, insurance, rent, supplies, and communication expense. Add those all together, and now they're sitting in the income summary account. So we just move them out of these temporary accounts into the income summary account. Step 3, close the income summary to capital. So right now we have the revenue and the expenses sitting in the income summary. So that's a credit balance of $1,995. So if we debit the income summary account by $1,995, it will bring the income summary account balance to zero. And then we move this into the capital account. So Haley Walker already has $10,000 in capital. We move her profit and add it to her original capital to give us a balance of $11,995. Step 4, close drawings to capital. So whatever she has in her withdrawal account of $600, if we credit that amount, we'll bring that balance down to zero. So all we're doing is we're moving this drawings up into the capital, and then we're adding the capital account up to get her final balance. 4-step closing process. 1, close the revenue into income summary. 2, close the expense into income summary. 3, close income summary into owner's capital. 4, close withdrawals into owner's capital. Account balances after closing. All temporary accounts, revenues, expenses, and withdrawal accounts will have a zero balance. The capital account will be updated to reflect profit or loss and withdrawals from the period just ending. All other accounts will be unchanged. Post-closing trial balance. A list of permanent accounts and their balances after closing entries are journalized and posted. It verifies that total debits still equals total credits for the permanent accounts and that all temporary accounts have zero balances. Mini quiz. Closing the temporary accounts at the end of each accounting period, A, serves to transfer the effects of these accounts to the proper equity account on the balance sheet. B, prepares the withdrawals account for use in the next period. C, gives the revenue and expense accounts zero balances. D, both A and C, or E, all of the above. All of the above. Classified balance sheet. A classified balance sheet organizes assets and liabilities into important subgroups. It provides users with more useful information for decision making. Exhibit 4-12. Assets. We have current assets. Then we have our non-current assets. And our non-current assets are non-current investments, property, plant, and equipment, and intangible assets. Then with our liabilities and equity, we have current liabilities and non-current liabilities and our equity. So Elite Board Shop, we're looking at their balance sheet for January 31st, 2020. And now what you'll see is our assets are subdivided into current assets. So everything that can be converted into cash within 12 months. You subtotal that to get total current assets. Then we list all of our non-current assets. So this is assets that will be converted to cash longer than a 12-month period. We have our non-current investments. We also have our property, plant, and equipment, and we also have our intangible assets. So those are all our non-current assets. Add those up together along with your current assets to give you your total assets of $343,800. Current assets are assets that are expected to be sold, collected, or used within longer of 1 year of the company's operating cycle. Operating cycles for a service company and a merchandising company. So the operating cycle for a service company is cash that you have already, then you can pay your employees, then you can provide services to your customers, and then you can collect the money from those customers, and then that'll give you the cash that you have available again. For an operating cycle for a merchandising company, we start with the cash that we have, we pay out cash for our products, we sell our products to our customers, then our customers pay us for what we sold them, and then we have our cash on hand again. Non-current investments are held for more than 1 year or the operating cycle. Property, plant, and equipment are intangible assets used for more than one accounting period to produce or sell products and services. Intangible assets are long-term resources used to produce or sell products and services. They lack physical form. Our current liabilities are obligations due to be paid or settled within the longer of 1 year or the company's operating cycle. So you can't actually go longer than 365 days. Our non-current liabilities are obligations due beyond the longer of 1 year or the company's operating cycle. So this is basically anything that will come due past the first 12 months. So it's not included in the first 12 months, it's just longer, so they're further away. Equity is the owner's claim on the assets of a company. Review. Question. What classes of assets and liabilities are shown on a typical classified balance sheet? Answer. Current assets, non-current investments, property, plant, and equipment, intangible assets, current liabilities, and non-current liabilities. Current ratio, using the information. Current ratio, a ratio that is used to evaluate a company's ability to pay its short-term obligations. So we have our current assets divided by our current liabilities. This ratio should not be used in isolation as a measure of liquidity. It will vary from industry to industry. It may be tracked over time to spot trends. It may be used to compare to industry norms. Quick ratio, using the information. Quick ratio, a current ratio that includes assets that are easily converted to cash. So it's cash plus equivalents, plus marketable securities, plus accounts receivable, divided by current liabilities. Or another way that you can think about it is taking your current assets and subtracting out the inventory, because we don't want to include inventory in this ratio, and then everything else listed below inventory, we kind of consider those dead assets, and then that should get you almost to the same number. Debt to equity ratio, using the information. Debt to equity, a ratio that indicates the risk position of a company. Debt to equity ratio equals total debt, so that is your total liabilities, divided by total equity. So that's your total shareholders' equity. We're not covering reversing entries. So I'm just going to skip through this. Summary. 1. Describe and prepare a worksheet and explain its usefulness. 2. Describe the closing process and explain why temporary accounts are closed each period. 3. Prepare closing entries. 4. Explain and prepare a post-closing trial balance. 5. Complete the steps in the accounting cycle. 6. Explain and prepare a classified balance sheet. 7. Calculate the current ratio and debt to equity ratios and describe what it reveals about a company's financial condition. 8. Prepare reversing entries and explain their purpose. That's Appendix 4A, which we're not covering. End of chapter.